So we've been looking at the 6 different methods that you can use for funding your business growth. And vendor finance has got to be probably my favourite option when it comes to using other people's money in order to grow your business. And when we say vendor finance, what we're referring to is a private arrangement between you and normally somebody that's selling something in order to fund the purchase of that payment. So historically, if you haven't had the money, you need to maybe buy a property, a commercial property, or some equipment in your business. You would go and get a business loan, and then you'd go and buy that normally second-hand item from somebody, and you would use the business loan to fund it. But what we've seen over the last few years, particularly as interest rates have risen, is that there has been an increase in the number of people who are coming to a private arrangement with the seller in order to pay for that item. So let's just say we're talking about a commercial premises or typically a high value piece of equipment, maybe a truck or some machinery or something like that. So if you are a private individual, you don't have this option available to you, because if you come to an arrangement with a private individual about lending you money, then actually that individual should be registered with the FCA in order to give a private individual a loan. But when you're a business, these rules and regulations don't apply, because from a business's perspective, it doesn't matter whether you're being given credit to pay an invoice or whether you're being given credit to buy a property. It's all classed under the same thing, and it's just peer-to-peer business loans, and it's unregulated. So that means that vendor finance, if you can find somebody, a vendor that is selling something, and that vendor is cash rich or doesn't have an immediate need for the cash and wants to just dispose of the asset, then this is a fantastic opportunity to ask for vendor finance. So one of the reasons why this can be really incredibly valuable, particularly in times of high interest rates and inflation, is the time value of money. So if you were to agree to buy something for £100,000 today, but maybe you might say to them, we'll buy it, but I can't afford to pay you for 12 months. The benefit to the vendor is that you take on the liability. Particularly if it's a commercial property, they're going to have business rates and maintenance and things like that to cover. So you take on the liability, but you don't make the payment for 12 months. And that means that with inflation at around 5%, if you agreed a sale price at 100k today, then actually in 12 months' time, theoretically that property is worth 105k, but you're only paying 100k for it. So the time value of money comes into it, and that's why it can make it incredibly valuable to businesses doing deals with private vendors. The other thing that is becoming more common with landlords and renting commercial property is that you'll agree a period of time where you might sign a commercial rental or lease contract with the vendor with the option to buy the property in X amount of years should you want to. So it's built into the contract that you agree the price that you will pay today. And that means that should property prices increase, then you benefit from the upside because you've already locked in the price. And should property prices decrease, then actually you've got the option to just walk away. So it could be a win-win situation. Now, often vendors will still require you to pay interest, but typically a vendor is going to be looking at this saying, well, I can get 5% on my money in the bank, so give me 7% interest. And so it will tend to be at a lower rate than a commercial loan, for example. And often you can be more flexible with the arrangements if you can find a vendor, like I say, that doesn't have an immediate need for the cash now. So actually, I'd say the most common times I see vendor finance agreed is when somebody's looking to retire. Maybe they're looking to just get rid of their business assets, such as a commercial property or some machinery, and they don't necessarily need the cash now. They just want to get rid of the asset and they want the headache gone because they just want to retire. So that's the type of scenario, if you find yourself in, have a chat with the vendor to see if you can come to an arrangement with them about how you pay them and not paying them 100% of the price up front. They will charge you interest. The interest is tax deductible, just as if you had bought anything using a business loan. So from a tax perspective, there's no difference here to if you are using a business loan. So vendor finance has got to be probably one of my favourite ways that you can use other people's money to fund your business growth.